Hey everyone, hope you are doing well today. We had a question in the group about taxation of entities, and so I thought that I would run some calculations on how different entities are taxed and what that tax looks like. To be honest, the results were a little surprising to me. It was heavily weighted to one entity over another. So let's work on going through that. Let's see, I'll share my screen here. We'll go to the presentation. All right, so here we have the our taxation of entities. So in this presentation, this is what we're going to cover. We'll cover legal entity choices, how you can the ways that you can be legally set up as an entity. So this means you go down to the state, you set up an entity with the state. Then we'll talk about tax entity choices. So the way that you are set up legally isn't always the way that you are taxed. Those two can be different, and a lot of times they are different. Then we'll talk about sole proprietor taxes, how they work at $100,000 of income. We'll do S corporation taxes, also at $100,000 of income. We'll then move on and do C corporation taxes on $100,000 of income and see the differences there. We'll do sole proprietor taxes at $1 million of income. Then we'll do S corp taxes at $1 million of income, and then finally C corp taxes at $1 million of income. We'll come back, we'll compare the effective tax rates of all of those options, and we'll compare the tax liabilities of all those options as well. And then we'll come and just sum it all up into one thing. All right, so as we jump into here, what are our legal entity choices? So first off, you can go down to the state. Well, kind of, not really. You don't necessarily have to set up a sole proprietor with the state because it's not really an entity. So a sole proprietor is anybody that just goes into business. So this would be like a high school kid that becomes a tutor and gets paid for that. My son did some coaching at the junior high. He's a high school kid in the debate team. Did some coaching for the junior high debate team. They paid him. He got a 1099 for that, had to put it on a tax return. He was a sole proprietor, had no legal entity or anything like that, but was a sole proprietor. Then you can go down to the state and you can form a partnership. And there's a couple options there. You can form a general partnership or you can form a limited partnership. Then you can go down to the state and you can form a corporation. And then, as everybody knows, everybody's favorite entity type is the LLC, the limited liability company. So if you were to go down to the state, those would be the options you would have to form an entity. You'll notice I didn't have S corporation in there. S corporation does not exist as a legal entity. It only exists as a tax entity. S corporation lives in the tax world, not in the legal world. So when you go down to the state, you just set up a corporation. That's it. It's not necessarily a C corporation. It's not necessarily an S corporation. It's just a corporation for legal purposes. Then as we get into our tax entity choices. So first off, we've got a sole proprietor. Same thing as just being a sole proprietor. And sole proprietors file a Schedule C. Then you have a partnership. So you could be taxed as a partnership. That's Form 1065. You get taxed that way. You can have a C corporation and file Form 1120. And you can have an S corporation and file Form 1120S. And then we've got LLCs. So how are LLCs taxed? What kind of tax form do we have for those? Well, maybe to take it back a step. So LLCs were created by Wyoming back in 1978. So they're relatively new. They're 42 years old now. I was born in 1979, so LLCs are just a little older than I am. But they didn't really catch on until the 1990s. And the reason for that was when Wyoming invented them, the IRS didn't know how to tax them. They said, oh, we've got LLCs, we don't know what to do. We have tax codes that exist to show how to tax sole proprietors. We have tax codes that exist to show how to tax partnerships. We have tax codes for C corporations. We have tax codes for S corporations, but we don't have any tax code for LLCs. What should we do? Should we form new tax code for LLCs? Should we use what we have? What should we do? It took them 10 years to figure it out. So from 78 to like 88 or the late 80s, the IRS was figuring this out. And they finally figured it out in the late 80s. And by the time they figured it out and everybody started learning about it, that's when everybody started setting up LLCs. So the way LLCs work is that if you have an LLC that's owned 100% by an individual, the IRS says, okay, let's call a single member LLC, and it's going to fall under the sole proprietor laws. So that's why a single member LLC files a Schedule C, because it's considered a sole proprietor for tax purposes. Then the IRS said, okay, if you've got an LLC and it's owned by more than one person, we're going to treat that like a partnership, and it's going to fall in the partnership laws. So that's what happens when you have a multi-member LLC. Then they said, okay, if you have an LLC that files a Form 8832, it's an entity election, then we'll treat that LLC as a C corporation, and it will file Form 1120 and fall under all the C corporation rules. And then they went on and said, okay, and if you have an LLC that files Form 2553, we're going to treat it as an S corporation. It'll file Form 1120S, and it'll fall under all the S corporation rules. So you can see here that there is no form for an LLC. You can't go to the IRS website and search for LLC tax form. You can't go to Google and search for LLC tax form. It doesn't exist. There's no such thing as an LLC tax form. Instead, an LLC is either a Schedule C, it's a Form 1065, it's a Form 1120, it's a Form 1120S. It could be any of those. So when a client says, hey, I've got an LLC, then you got to say, okay, well, who owns it? How many people own it? Have you made any elections to be treated as a C corporation or an S corporation or anything else? Because it could be any of those things. So those are our tax entity choices. So how exactly are these taxed? Let's get into that. So here's our tax calculation for a single member LLC. So if we have our net income equals $100,000, the owner of the business will pay $10,065 in income tax after the 20% business income deduction. So as we go through these examples, it's important to note that I put all of these examples in tax software. So I use Lacert in my practice. So I put all of these in Lacert. So these are numbers that come straight out of tax software. The way I put them in as a single individual that was making $100,000 or making, whatever the example is. This is all based on single individual, standard deduction. These are the numbers that come out of it. So the owner of this business pays $10,065 in income taxes after the 20% business income deduction. So that they're effectively taxed on $80,000 of income. The self-employment taxes on $100,000 of income equaled $14,130. And the LLC owner pays $24,195 in taxes when you total those up, the $10,065 plus the $14,130, and then the tax rate on that is about 24.2%. So if you take this 24.195 is basically 24.2% in taxes that a single member LLC will pay on $100,000 of income. Next, we got our S corporation example. So again, net income equals $100,000. So the owner of the business will pay $12,980 in income taxes after the 20% business income deduction. And this is assuming a reasonable salary of $50,000. You can see that income tax-wise, they're paying more because the way the qualified business income deduction and things like that work, they end up paying a little bit more of income tax on there. So now S corps do not owe self-employment tax like we saw in the single member LLC example, but owners are required to take a reasonable salary and they pay employment taxes on that reasonable salary. So if reasonable salary is $50,000, then $7,065 will be paid in employment taxes. So here, an S corp owner pays a total of $20,045 in taxes. They pay the $12,980 plus the $7,065. They're at $20,045 in taxes. So their tax rate is about 20% for that. And we'll go through all these tax rates and the tax amounts at the end so you can see a good comparison of each of them. And then let's go to the C corporation. So here we have our C corp. So net income equals $100,000 again. C corp tax rate is a flat 21%. So a C corporation will pay $21,000 in income taxes. Distributions are taxable as qualified dividends, and the shareholder so in this case, the shareholder pays $4,114 of tax just on the dividends. Now, that seems really, really low, and because some dividends are taxed at 0% due to graduated tax rates, so they actually get a good savings there. So in this example, a C Corp owner pays $25,114. So that's the $21,000 plus the $41,414 in tax on $100,000 of income, making the tax rate 25.1%. So if you're keeping track there, this is now the highest taxed entity out of the three options. So where this surprised me was I thought that at $1 million, things would change quite a bit. And I thought C corporations might be more beneficial, but let's see how those numbers play out as we get into our $1 million examples. So here we got our single member LLC, net income equals $1 million. If the income tax rate is 37%, the owner of the business pays $250,973 in income taxes. So again, that $250,973 came directly out of the tax software. I put in $1 million into a Schedule C, allowed them to get the qualified business income deduction on it, and it came out with $250,973. Self-employment taxes on the million of income equals $43,261. Again, straight out of my tax software, that's the number that it came up with. Additional Medicare tax on the self-employment income. So you have this additional Medicare tax that gets added on to self-employment income, and that was another $6,511. So in total, this LLC owner pays $300,745 in taxes on $1 million of income, which is about 30% tax rate on that income that they paid. All right, so let's go into S Corp example number 2. Again, at $1 million. So our S Corp net income is $1 million. The owner of the business will pay $260,174 in income taxes after the 20% business income deduction. So this is again assuming a reasonable salary of $50,000, comparable to our $100,000 example. And that $260,174 again came right out of a tax software. Using 2019 software since 2020 is not out yet. Again, S Corps do not owe self-employment tax, but owners are required to take a reasonable salary. So again, if they take that reasonable salary of $50,000, they're paying that $7,065 again in self-employment taxes. And so in this example, the S Corp owner pays $267,239 in taxes on $1 million of income. So the tax rate's about 26.7% on that. All right, and then the one example that really surprised me, I thought that this one would come in quite a bit lower because we have a nice flat tax rate on C corporations. So here's the surprising thing about C corporations. So the net income equals $1 million in the C corporation. So C corp tax rates, again, 21%. So a C corporation will pay $210,000 in income tax itself. Distributions are taxable at qualified dividends. So here the shareholder will pay $130,011 of tax on the dividends. And then the shareholder will also pay $22,420 in net investment income tax. So that's another tax that gets added on. So the net investment income tax is there as well. And then, so in this example, the C Corp owner pays $362,431 of taxes on $1 million of income, which gives them a tax rate of 36.2%. To be honest, I thought that at $1 million, a C corporation would beat an S corporation, but the numbers just don't play out, especially if we're taking that reasonable salary of $50,000 that's in there. That it really depends on that. So if reasonable salary goes up, obviously more taxes go up, but they're not going to go up that much. In this example, I just don't see how a C corporation is really a good entity. So here's our effective tax rate comparison. So at $100,000 of income, Schedule Cs are paying 24%, S corporations are at 20%, C corporations are at 25%. So there, the clear winner is an S corporation. Taxes at $1 million of income, 30% for a Schedule C, 26.7% for an S, 36.2% for a C. You can see our tax rate between an S and a C is almost 10% difference in tax rate, which is crazy, but makes sense. Now, you might be wondering how this might work out with the election, with depending on who comes out there. If it's Trump and the Republicans, then these rates probably stay the same. If it's Biden and the Democrat side, then he's already said he would raise that C Corp tax rate up to 28%. So these numbers would only get worse with Biden, with presidency under Biden. So the income tax rates will go up. The self-employment tax rates stay pretty much the same. I'd say if we have a Democratic presidency and we start to see tax law changes there, it's going to make the C corporation even worse. They'll be taxed even more. Tax liability comparison. So let's look at this. So Schedule C, you're paying $24,000 at $100,000 of income. For an S corporation, you're paying $20,000, and C corporation is $25,000. So you have a $5,000 difference in tax at $100,000 of income between an S corporation and a C corporation. At $1 million of income, our Schedule C is paying $300,000, S corporation's paying $267,000, and C corporation $362,000, a $95,000 difference between an S corporation and a C corporation. Even if you're making $1 million, $100,000 is a pretty good chunk of change for a big difference there. So summing it all up, so C corporations are very tax inefficient. You get double taxed. You taxed at the corporate level, you get taxed at the individual level. Now, it is possible to leave money in a C corporation and not pay tax at the individual level. You can just pay that corporate level tax, but that money will need to come out someday. You can't just leave it in there. You got to survive on it. You got to live on it. And some people say, well, you know what? That's great. Your C corporation makes $1 million. We'll just take out $1 million of salary and zero that out, so you're not paying the double tax. Do you know where that gets you? That gets you back to the Schedule C comparison, because now you're paying employment taxes and everything. So yeah, it does save you tax by saying, I'll just take it all out of salary. You basically get taxed as like a Schedule C income at that point, and you're still paying $300,000 of tax, whereas an S corporation is paying much less. Now, if money is left in a C corp for too long, then the IRS has this wonderful other tax called the accumulated earnings tax, and that could apply. I actually had a client that was audited for this probably 10, 12 years ago. They were a C corporation at that time. About 10, 12 years ago, we converted all of our C corporations to S corporations for these specific reasons that we're going through. And keep in mind, we haven't even talked about state taxes. State taxes would add a whole nother level and make this even worse on top of it all for C corporations. So anyway, this client got audited. We'd already converted them to an S corporation, but the IRS wanted to audit them for the C corporation. Luckily, we were able to get through that okay, and they didn't owe this accumulated earnings tax, but that is another sword that the IRS could wield and say, oh, you left too much money in there, now we're going to tax you again. The other downside of a C Corp is that if that ever has any losses, so here we are in 2020, we got COVID, we got losses, we got all sorts of stuff. If you have a C Corporation, those losses are trapped there. So if you have a business owner that's putting just money into the C Corporation, trying to keep it alive, and it throws off a huge loss, that's not going to do anything to benefit his personal tax situation. That gets stuck at the C corporation, creates a net operating loss, which then they might be able to carry back, or they just carry forward. It's not going to give them a whole lot of benefit until they make some income in there. Schedule Cs are better than C corporations, but are still pretty inefficient if reasonable compensation is less than their business income. So in all those examples that we gave, the $100,000 of income, we had a reasonable salary of $50,000 in there. So our reasonable salary was less than the income. If your reasonable salary is the same as the income that's in there, then it doesn't do a whole lot of good to convert to an S corporation because the savings just won't be there. And then let's see, if we go here, if reasonable compensation is less than income, then S corporations are a good option to consider. So everything is really based on that reasonable compensation. So it's important to know that number. What is reasonable compensation? Then you look at the entity income and say, okay, is reasonable compensation more or less than the income? And then you go from there on it. And then if, like I said, if reasonable compensation is more than income, you then consider staying a Schedule C, because you're not saving any money by going to S corporation at that point. And okay, so that runs through all that. Let me know in the group there if you have questions on any of that, or any comments about how that calculation works, or how we went through those. Again, I put everything in tax software, 2019 software, assumed a single individual that was making $100,000 or $1 million, and seeing how they got taxed under all those different entity types. But yeah, hopefully that is helpful and beneficial. And yeah, let me know any questions that you might have in that, and we'll have a good day. Enjoy the elections today. We'll see how that pans out and plays out. And depending on what happens there, we'll come back and talk a little bit about some tax ideas, what taxes we can expect to change. It's always interesting in an election year, and maybe we'll talk about that for a second since we have a moment here. I've got a client coming in a few minutes, but I do have a couple minutes. You know, every time we have an election, and I've seen these cycles come and go quite frequently between, you know, when I started my career, it was early in 2000. So we had this transition between Bill Clinton and George Bush. And you know, we saw George Bush come in. I was actually in school when all the Bush tax cuts came in, so I was able to see those and learn how those all worked. And then started my career under Bush and what were called the Bush tax cuts at that time. And then Obama came into office, and we saw Obama and how that affected tax policy and how the 8 years of his presidency played out. And now we've had 4 years of President Trump and how tax policy has played out. And you always see this swing between the two. And it really depends on congressional control. So, you know, you could have a Republican president, you could have a Democratic president, but if Congress underneath them is not all Republican or all Democrat, then the tax policy has a hard time getting going, right? Because the tax laws really start down there at Congress. You got the Senate and the House that are the ones that are making the laws. And you know, if you have, let's say, an example when you know, for like Obama, let's say Obama, you had a Democratic president, and then you had a Republican Congress, then you know, they just were not creating laws that would change taxes significantly because you know, they didn't want to. You know, then when you had a change in control, let's say, and Congress became more Democratic, and now you had a congressional that was fully Democratic and a president that was Democratic, well, now you can get things moving that way because now the Democrats in Congress will write the laws that they want, the tax laws, and they have a president that they know will sign those tax laws, and so they're able to get those through. Same thing happened with Trump when he was in president. So you had a congressional majority there being Republican, so Congress was able to write tax laws that they wanted to have, get those through. Trump signed them. Then we had all the tax law changes. So depending on how the election plays out today, you know, if Biden does win, it'll be key to see what happens in Congress, because if we get a change in Congress as well, you're guaranteed to see huge changes in tax law going forward. But if Congress remains kind of split or you know, Republican controlled, then we might not see changes in tax law happen all that quickly. So it just kind of depends. Well, it'll be an interesting to kind of watch today how things play out in this election and where things are going to go after that. So yeah, with that, we'll end this, but let me know what questions you might have, and we'll keep things up to date with what's going on, tax law changes, and what we can expect going forward. So hope you have a good day, and we'll see you later.